had a comment, I think it was yesterday, and I just have some time now to record a video. The question was about the withholding taxes on dividends for US equities when owning them as a foreigner. Obviously, that's at 15 to 30%, which can be taxed. So firstly, I'm guessing this user is a foreigner who owns US equities and is experiencing that withholding tax on those dividends. So many countries have tax treaties with the US, and obviously that can reduce the holding rate from 30% to as low as 5% or even 0% in some cases. For instance, residents of countries like the UK, Japan, Germany can definitely qualify for a rate of 15%. If your home country has a treaty, then obviously please ensure that you do, I think it's the W8 BEN, so the W8BEN document, and you can obviously apply for those treaties. These are the treaties here, so you can see it on this table. Dividends paid by US corporations in general, dividends qualifying for the direct dividend rate, and interest paid by US here. So you can go ahead, you can see all this on the screen. I can drop a link to this spreadsheet if you want as well, so then you actually have it, and these are all of the treaties which you can do. Now, obviously, the 30% is significant, it's a complete nightmare. Other things you could look at doing are the island domiciled ETFs. So investing in the US stocks through an Irish domiciled ETF can often be very beneficial. These ETFs pay no withholding tax on dividends on US stocks due to the tax treaty between the US and Ireland, which means you can receive your dividends without the standard rate of 15 or 30%. So this is a potential method you could do to reduce that aspect right there. Now, there's also the UCITSs, which is very similar to the Irish. So it stands for Undertakings for the Collective Investment in Transferable Securities, and these can be very tax efficient as well. If the ETF version is available on this, you can obviously reduce or even avoid it completely, if that is possible. So the other thing you could do is potentially holding the tax in deferred accounts. If you're considering holding the US equities in a tax deferred account like an IRA, remember this can delay the US tax implications until the actual withdrawal. So you won't actually benefit from the foreign tax credits on the withheld taxes. However, it is a little bit beneficial, but it's much less beneficial than the Irish. I really would say the Irish is the best thing to do. There's some other stuff such as the scrip dividends. So some companies offer those actual options to take dividends in the form of additional shares rather than cash. This could be beneficial, meaning you're not obviously paying those withholding taxes, so you can bypass it as there is no cash transferred. Although this isn't really, I would say, universally available in most scenarios, but you can always look into that. It depends on what US equities you are owning and how large of a portfolio you have, or an investment you have within that particular US equity. But if it was me, then obviously the Irish ETFs that allow you to go into the US markets is the best way moving forward. There are no withholding taxes on those island domiciled ETFs. So that's the answer to your question. Again, just book a call with me, mate. Drop me an email, my email somewhere, will.hodgson@forwardpointsolutions.com, or you can go over to our website. But yeah, those are my explanation to that question. I can also drop this spreadsheet here if you want to, so you can see the treaties between those countries, if that kind of makes sense right there. And again, the best way to do it would be the island domiciled ETFs.